It's great to see you and great to check in every quarter. So, can you just can you explain what changes you made to the portfolios last quarter?
Yeah, so one of the big changes that we made in the last quarter with kind of the run up in the top 10 stocks of the S&P 500 and valuations kind of getting more stretched, particular names like Tesla and Nvidia. So to mitigate that risk, we did shift a portion of the portfolio into an equal weight S&P 500 ETF. And so all that does, it takes the same stocks that are in the S&P 500 and just gives them the same weighting. So effectively that underweights those big top 10 names and kind of like say neutralizes the overall concentration risk.
That makes a lot of sense. So when I review the numbers, I'm amazed that the Nasdaq is up 35% year to date. So, what should I be telling clients? Is that going to continue or fat chance?
Well, in my opinion, when you're looking at the Nasdaq, it's obviously driven by a lot of the stocks that were down significantly last year. There's several names that were down 80% last year, like Carvana, that is up 100% this year. So part of this is what people are calling the FOMO trade. A lot of retail investors hopping back in some of these smaller names. But additionally, artificial intelligence and the narrative around that seems to be what's driving a lot of these stocks. And, it kind of turned into a little bit of a meme over the last earnings season where it seemed like every CEO that had something to do with artificial intelligence made sure you knew about it. So that seems to be what's driving a lot of the momentum, at least in stocks. Like I said, our fear is that valuations at this point look quite a bit stretched, in particular in those Nasdaq tech type names.
Right.
And
That makes sense.
that's an important point, is that we've seen where momentum can carry performance regardless of the quality of the company. But right now we're in a period where valuation matters. And when even beyond tech, I would argue in some of the other areas of the S&P 500, like in the equity market, valuations are stretched. And we're seeing, even after the correction, we're seeing valuations in that 22 times, 24 times earnings, where we would expect it to be closer to 18 times earnings. The exception might be in the bank and finance sector, especially the regional banks went through a difficult period last March. And we haven't really seen a recovery. We've seen a little bit of a bounce back, but stocks like Wells Fargo, Truist, US Bancorp, we think are still real cheap.
The one thing I'd add that could undo that a little bit, or at least extend it, is if we did continue to see inflation drop and you saw interest rates on the long end of the curve continue to come down. I think that could continue to push the narrative that valuations at these levels could stay high for a little bit longer. We've seen that come and go at times. So if there's something that could undo that thought in the short term about valuations, it would be that. But long term, like Greg said, valuations ultimately do matter.
Okay. And I wanted to ask you about just a couple of sectors in particular. So when do you think healthcare and biotech is going to turn around?
I'll hit on the healthcare. Yes, it has kind of been the laggard across the S&P 500, and just looking last week at companies like Merck that basically are trading back to their pre-COVID levels despite increased sales from their COVID vaccine. So valuations look really, really good for healthcare names right now. So in addition to that, they're obviously a little bit more defensive, and so going into this theme of playing more defense, looking at more attractive valuations, that we do think healthcare set up to outperform. So it is a sector worth looking at.
One of the things in healthcare also, if I could add, is the this movement on obesity drugs is a real opportunity for the pharma companies that can really crack this nut, because there's just, whether we like it or not, there's significant demand for it away from diabetes. And Eli Lilly is one of the companies that has a drug could be a potential blockbuster just because of that.
And now, so the Fed is meeting next week. And so what do you think they're going to do?
Well, I think we've got we're in the ninth inning in terms of the Fed's push to tighten monetary policy. We expect by the end of the year, we expect one more increase, one more 25 basis point increase. I don't think personally that we're going to see much more from here. And if the Fed decided to pause, they've got enough reasons to pause, but our expectation is the way that the narrative is coming out, it's one more increase.
Okay. Yeah, fair enough. That makes sense. Thank you so much. Any other comments about what our clients need to know for this quarter?
I would say this, on the bond side, we are still very, very constructive in fixed income, especially with the move. We saw the 10-year during the July 4th holiday move up to 4% again, and it's declined from there. But in the both corporate credit, municipal bonds, it's a gift at these high levels of interest rates and these wide spreads to earn that level of income into a portfolio. So we think there's value there. Credit is still, we've got concerns around business development companies in certain parts of the credit markets. So we want to be conscious of that. It's not just back up the truck and buy the market necessarily, but to be able to shape an individual's portfolio to earn a level of income, it still can be done. And I don't know if we look through this as Adam suggested, and we look through into the future, when the Fed's decided they're done raising interest rates, the economy is slowing, we'll see that decline in interest rates, and it largely could happen that we see the longer end decline as well, depending on the severity of any economic decline.
Okay. Well, good. Well, thank you so much. I appreciate the update. I'll share that with clients, and I look forward to speaking with you guys next quarter.